They'll tell you the economy is resilient, that we dodged the worst, that the recession never came. But if you're living through 2025, you can feel something is wrong. Paychecks don't stretch like they used to. Layoffs keep coming quietly. Markets jitter on whispers. And yet, officially, it's not a crisis. It's a paradox. Growth without prosperity. Employment without stability. Stimulus without relief. We've seen this before, but not in 2008, not in 1929. The real comparison is 1937. Yes, 1937. Not the crash, not the Dust Bowl, not the breadlines, but the year America almost came out and then sank back in. Back then, the headlines said the Great Depression was over. Factories had restarted, stocks had risen. Washington was celebrating the New Deal miracle. And then suddenly, another plunge. Industrial production collapsed 32% in a year. The stock market lost half its value. Unemployment shot back to nearly 20%, all while economists insisted things were normalizing. Today, the same eerie signs are surfacing: a premature declaration of victory, a fragile recovery built on debt and hope, and then the tightening, the slow tightening, not just by central banks raising rates, but by invisible hands, falling real wages, evaporating liquidity, and a creeping credit crunch. You're not supposed to notice. That's why it's a silent depression. Like 1937, it hides behind numbers that look good on paper, but arithmetic is patient. And when it returns, when math catches up with politics, it doesn't ask for permission. We've been taught to see history in explosions, crashes, revolutions, riots. But depressions often creep. They don't announce themselves, they accumulate. The great lie of 1937 was that the worst was behind us. The great lie of 2025 is the same, because underneath both was the same machinery, built with good intentions, cheered by markets, but ultimately unsustainable. A mechanism we'll expose, step by step, who built it, why it worked for a while, and what it takes down when it breaks. If you feel the system around you is stalling, but no one can explain why, stay with this. This is how depressions really work. Everyone remembers the slogans of the 1930s, the New Deal, the alphabet agencies, the heroic image of a government pulling a nation out of despair. But almost nobody talks about the mechanism underneath it all, the real engine, the part that made the recovery look smooth, steady, unstoppable, until it suddenly wasn't. If you look closely, both 1933 and 2020 began with the same decision: flood the system with money and hope the real economy catches up later. Roosevelt did it by severing the dollar's link to gold in April 1933 and revaluing gold from $20.67 to $35 per ounce, a stealth 40% devaluation. The modern world did it through trillions in digital liquidity: quantitative easing, stimulus checks, corporate bond buying, repo injections, zero rates. Different tools, same logic. Create money first, solve the crisis second. The official story is simple. The government had to act. Banks were collapsing. Companies were shutting down. Without intervention, the entire structure would fall apart. And that's true, but it's only half the truth. The part they don't emphasize is who benefited most and why. In the 1930s, it wasn't the farmers or factory workers who gained the most from Roosevelt's monetary revolution. It was the creditors. The same banks that had choked the economy with deflation after 1929 suddenly found themselves holding assets that were rising in nominal value and debts that were easier to collect. Every dollar owed to them had been quietly devalued, making repayment more likely. The government had transformed a national emergency into a balance sheet rescue. The pattern repeated a century later. Between 2020 and 2022, central banks created over $10 trillion globally. The narrative said it was to save households, but look at where the money actually traveled: into stocks, into bonds, into housing, into the spreadsheets of institutions that already held assets. When the Federal Reserve bought $80 billion per month in treasuries and $40 billion in mortgage securities, it wasn't depositing cash into your account. It was swallowing financial risk off the books of banks, hedge funds, and large investors. The mechanism saved the system because it stabilized the portfolios of the most powerful actors inside it. In both eras, an elite coalition formed quietly in the background: the government that needed growth, the central bank that needed stability, and the financial institutions that needed their assets protected. Together, they built a recovery machine that relied on constant injection, monetary adrenaline. But every machine needs fuel, and this one burns trust. In the 1930s, trust came from gold. People believed that, despite the devaluation, the government still held something real in Fort Knox, something tangible. Gold was the psychological anchor. As long as gold sat in vaults, the public tolerated massive spending, new agencies, and experimental economic policies. In the 2020s, trust came not from gold, but from the illusion of infinite liquidity. As long as central banks said, "We will do whatever it takes," markets believed the game could continue indefinitely. As long as interest rates were near zero, governments could borrow without fear. As long as digital money could be created at a keystroke, nobody asked where value actually comes from. Yet both systems shared the same flaw. They were built on temporary scaffolding. A recovery that depends on artificial support stops being a recovery. It becomes a dependency. Roosevelt knew this. He warned his own advisors in 1936 that the economy still needed careful nursing. But political pressure demanded optimism. So in 1937, the support was pulled back too soon. Government spending slowed, the Federal Reserve tightened, and the system collapsed inward. It wasn't the spending or the tightening alone that caused the crash. It was the structure they had built, a financial ecosystem unable to stand on its own legs. Modern policymakers made the same bet. They assumed they could slowly withdraw stimulus without breaking the machine, raise rates, shrink balance sheets, restore normal. But the system they built between 2020 and 2022 was never normal. It was a crisis apparatus, designed for survival, not for sustainability. And when a structure is built to be temporary, its timing becomes fatal. Look at the numbers. In 1936, U.S. public debt had risen to unprecedented levels for peacetime. By 1937, tax revenues couldn't match political promises. In 2024, U.S. interest payments passed $1 trillion per year, surpassing defense spending. Corporations borrowed cheap money for buybacks, not productivity. Households borrowed to survive inflation, not to build wealth. The scaffolding was still there, but the weight on top had doubled. The hidden beneficiaries understood this dynamic perfectly. Banks prefer a world where the state guarantees their stability. Bondholders prefer a world where inflation rises just enough to erode government obligations, but not enough to threaten their assets. Politicians prefer a world where voters feel relief but never see the invoice. All three groups benefited enormously during the stimulus phase. None of them planned for the moment when support would be removed. This is the core of the mechanism, a system built to rescue itself, not the people inside it. It looks like compassion, but functions like triage. It promises recovery, but creates reliance. It starts as salvation and ends as constraint. And the tragedy, both in 1937 and in 2025, is that everyone believes the miracle while the fuel lasts. The moral is simple. Systems don't collapse because people have bad intentions. They collapse when the structure underneath grows faster than the foundation beneath it. Everyone wants to believe the worst is over, that the medicine worked, that we can go back to how things were. By 1935, the U.S. was dancing again, cautiously but with rhythm. Wall Street was rising. Factory output surged. Roosevelt smiled on national radio and said, "We are definitely on the road to recovery." And why wouldn't people believe him? The numbers looked good. GDP was up 8.9% in 1935, then another 13% in 1936. Unemployment, while still high, was finally falling. The newspapers called it a miracle of planning. But beneath the headlines, the foundation was cracked. What looked like a true recovery was a heavily staged illusion, engineered through mass spending, emergency credit, and a suspension of the normal rules of finance. The U.S. Treasury and Federal Reserve were pumping money while pretending it was organic growth. In modern terms, they were doing QE before QE had a name. It worked for a while, because illusion is most convincing when backed by numbers. Industrial production rebounded by 50% in 2 years. The stock market doubled. Even housing started to recover. It felt like liftoff. But ask yourself this: what was driving that growth? The answer wasn't productivity, it wasn't new technology, it was government checks and monetary fumes. The illusion was built on deficit spending, $4.8 billion in relief programs, a colossal figure at the time. It was the Works Progress Administration hiring millions. It was the Social Security Act promising future income even before the system was fully funded. In short, it was borrowed time. Now zoom to 2021. We were told it was a V-shaped recovery. Stocks roared. Tech companies exploded. Home prices soared at the fastest pace since the post-war boom. Trillions in stimulus flowed through the system: paycheck protection loans, child tax credits, eviction moratoriums, student loan pauses. Central banks had dropped rates to zero, then lit the fuse on the asset rocket. Bitcoin, Tesla, SPACs, everything went up. It felt like a new era. But the same question applies. What was driving that boom? Again, not productivity. Real GDP per capita barely moved. It was stimulus velocity, artificial fuel injected into every crevice of the economy. And like the 1930s, the beneficiaries were not the average family. They were the holders of leverage: financial institutions, hedge funds, private equity, real estate portfolios. When Roosevelt devalued the dollar in 1933, the gold price rose, but so did commodities. Farmers were saved, but so were grain traders and futures speculators. When Powell flooded the system in 2020, job losses were cushioned, but the top 10% saw their net worth balloon. The illusion works because it doesn't feel like a trick. Your neighbor's house value doubled? That feels real. Your stocks went up? That feels like recovery. Your company rehired you? You feel grateful. But all of it, every data point, was riding on a temporary mechanism. In 1936, when the government began to pull back spending, the cracks were already there. The economy had grown dependent on continuous injections. The moment it slowed, everything wobbled. Private investment hadn't returned in full. Banks still hoarded reserves. Consumers were cautious, and businesses were suspicious of what might come next. The same agencies that fueled growth had no exit strategy. In 2022, central banks tried to normalize. Rate hikes began, bond buying slowed, and again the illusion faltered. Markets dipped, crypto collapsed, layoffs began, slowly, then faster. The public was told this was healthy cooling, but underneath, something deeper was breaking: the assumption that growth could survive on its own. That's the heart of the illusion. It tricks both the rulers and the ruled. Politicians believe they've engineered a soft landing. Citizens believe the pain is behind them. But neither sees the core truth. The system wasn't cured, it was sedated. The illusion is seductive because it gives the appearance of progress without the substance. It's easy to grow GDP when you inject trillions. It's easy to reduce unemployment when you create government jobs. It's easy to lift markets when you remove risk with central bank guarantees. But eventually, someone has to pay. In 1937, that moment came when Roosevelt, fearing inflation and budget deficits, cut spending and raised taxes. The illusion snapped. Industrial production fell by a third. The Dow Jones dropped 49%. Unemployment surged again. In our time, the illusion was pierced by inflation. Not the gradual kind, the violent kind. 9% CPI in mid-2022. And suddenly, central banks had no choice. They had to end the party. Rates shot up. Liquidity dried up. And just like 1937, the system began to seize. But here's the final twist. Even as cracks appear, many still believe the illusion, because the architecture of hope is powerful. Markets still price in soft landings. Politicians still promise transitory pain. And people, desperate for stability, cling to the idea that someone is in control. But arithmetic cannot be deceived. If growth is borrowed, it must be repaid. If wealth is inflated, it must be corrected. If the foundation is weak, it doesn't matter how high the numbers climb. Collapse becomes a question of when, not if. This is the moment between appearance and reality. the dance before the fall. There's a moment in every engineered recovery when arithmetic stops cooperating. When the numbers that were once manageable, the debt, the interest, the deficits, start to move on their own, quietly at first, then violently. That moment came in 1937. The U.S. government, believing the worst had passed, tried to normalize, cut spending, raise reserve requirements at the Federal Reserve, let the market breathe without support. It made sense politically. The public was weary of deficits. Inflation fears were rising. FDR's own Treasury Secretary, Henry Morgenthau Jr., warned about living beyond our means. So they pulled the plug, and the illusion shattered. Within months, industrial production collapsed by 1/3. Steel output, a bellwether of real growth, fell from 80% capacity to just 19%. The stock market lost half its value between August 1937 and March 1938. Unemployment, which had dropped to 14%, surged back to 19%. In cities like Detroit and Chicago, it felt like 1932 all over again. What failed wasn't the idea of intervention. It was the belief that you could taper off artificial growth without consequence. The economy had become dependent on state-sponsored demand. Remove it, and there was nothing underneath. The same thing is happening now. By 2025, the cracks are no longer hairline fractures. They're structural. Just look at the balance sheet of the United States. After years of near-zero interest rates, the debt had ballooned, over $34 trillion by early 2024. At first, that didn't matter. Servicing the debt was cheap. Rates were low. Investors were confident. But once the Fed started hiking to fight inflation, 5.25%, 5.5%, 6%, the math changed. Now, interest payments alone cost over $1 trillion annually. That's more than the entire U.S. military budget, more than Medicare, more than any discretionary program. The government must borrow just to pay interest on what it already borrowed. And here's the twist. Raising taxes doesn't fix it. Cutting spending doesn't fix it. Because the real problem isn't policy, it's the structure. Just like in 1937, the economy isn't self-sustaining. Private investment is weak. Productivity is stagnant. Corporate profits rely on cheap credit, not innovation. And households? Households are drowning. Credit card debt passed $1.3 trillion in late 2024. Delinquencies are rising. Real wages haven't kept pace with prices. Savings are gone. Defaults are creeping up. Auto loans, mortgages, student debt. Yet the headlines still say, no recession. Because the numbers, once again, are being massaged. In 1937, GDP didn't collapse all at once. It eroded in segments. Rail traffic dropped. Inventories built up. Durable goods orders fell. Economists debated whether it was a technical correction. But for the worker losing his job, it was the Depression all over again. In 2025, the same. Layoffs are spreading, not in one dramatic wave, but sector by sector. Tech, then finance, then logistics. Small businesses closing quietly, temp jobs vanishing. Yet the official unemployment rate stays low because definitions change. Because full-time jobs are replaced with part-time contracts. Because a statistic is not a person. And through it all, central banks are trapped. If they lower rates, inflation roars back. If they raise them, the debt implodes. In 1937, the Fed tried to regain control by raising bank reserve requirements, a primitive form of tightening. It backfired. Liquidity dried up, banks froze, and credit evaporated. In our time, the tools are more complex: repo markets, reverse repos, quantitative tightening. But the outcome is the same. The credit engine stalls. And when credit stalls, the system breaks. Because our modern economy isn't built on productivity, it's built on debt velocity. The collapse isn't always loud. There are no breadlines in 2025, yet. But there are invisible signs: rising defaults, falling consumer confidence, shrinking profit margins. You see it when retailers close early, when housing markets freeze, when bond yields invert and refuse to normalize. This is the silent part of the Depression, the part where no one declares it, but everyone feels it, where the official story is optimism and the lived experience is stress. You wake up, everything costs more, but your income hasn't moved. You apply for a job and hear nothing. You feel the slowdown before the media catches up. And the worst part? This was predictable. When you build a system on perpetual stimulus, you guarantee a moment of reckoning. When the withdrawals begin, the dependency is exposed. That's what happened in 1937. That's what's unfolding now. The myth is that depressions begin with crashes. The truth is, they begin with math. With the numbers no longer obeying policy, with budgets that cannot balance, with promises that cannot be kept. And once the numbers revolt, the politics follows. In 1938, Roosevelt lost control of Congress. Populists rose, labor unrest flared, faith in institutions eroded. People stopped believing in recovery. Sound familiar? The system we inherited wasn't built to last. It was built to delay collapse. But the bill has arrived, quietly, mathematically, inevitably. History doesn't repeat, it compounds. It doesn't come back in black and white images of soup lines and dust storms. It comes dressed in new language, new metrics, new distractions. But the structure underneath? It's the same echo, just louder. After 1937, the U.S. economy limped through another recession. The pain was sharper because it followed hope. Americans had tasted recovery, then had it ripped away. The political center fractured. Roosevelt, once untouchable, faced fierce resistance from both the left and the right. Confidence in the system, in money, in policy, in leadership, was shaken. Not destroyed, but deeply altered. Sound familiar? In 2025, the fracture lines are everywhere. You don't need a PhD to see them, just a grocery receipt, a rent payment, a look at your bank balance. For years, the illusion of prosperity was kept alive by low rates, high valuations, and the endless promise of growth. But now, the scaffolding is collapsing, and no one is offering a new blueprint. Worse, we're caught in a loop. Every fix of the last crisis became the cause of the next one. The 2008 crash, caused by cheap credit and financial engineering. Fixed by even cheaper credit and even more financial engineering. The COVID crisis? Solved by blank check stimulus, 0% rates, and central banks buying their own government's debt. A strategy that sparked inflation, which now demands tightening. And tightening is breaking the very recovery they claim to have built. This is what we mean by an echo. It's not just that events look similar. It's that the response mechanisms haven't changed. They've just become more automated, more centralized, and more fragile. In 1937, the mechanism broke because the government assumed the recovery was real. Today, the mechanism is breaking because we assume the system could absorb infinite shocks without ever resetting. Ask yourself, who benefited most from the last 5 years? It wasn't the middle class. In fact, the middle class was hollowed out, again. While nominal wages went up, real purchasing power shrank. Homeownership fell. Healthcare and education became luxury goods. The so-called wealth effect made the rich richer, while average families took on debt just to maintain the illusion of stability. And the architects of this illusion? The same ones from every cycle. Central banks, who kept rates low far too long. Governments, who spent without discipline. Corporations, who used cheap money not to innovate, but to inflate stock prices through buybacks. Creditors, who structured the entire system to funnel interest payments upwards while externalizing risk onto taxpayers. If this sounds conspiratorial, it's not. It's just accounting. A machine was built not to steal, but to transfer. Not to collapse, but to contain collapse until it was profitable to allow it. And now, in 2025, we're seeing the price. The consequence of a system that chose inflation over austerity, speculation over savings, and perception over reality. You'll see it in strange places, like commercial real estate, skyscrapers in major cities half empty, their debt burdens rolling over at higher rates. Quiet bankruptcies, malls turned ghost towns. Office space collapsing, not in a single crash, but in slow rot. Or small towns, where stimulus once kept shops alive, but now rising costs and vanishing credit finish what lockdowns began. Or youth unemployment, dressed up in fancy terms like freelance flexibility, but underneath it's the same story. Too many workers, not enough real jobs. The echo is loudest in debt. By 1938, it was clear that the private sector couldn't recover on its own. The state had to re-intervene. Deficits exploded again. Debt rose. But this time, the U.S. had a secret weapon: war. World War II did what New Deal spending couldn't. It forced reindustrialization, absorbed labor, and reset the global monetary order. But in 2025, what's our release valve? There's no gold-backed currency to return to, no wartime economy on the horizon, no Bretton Woods to rebuild trust. Instead, we get what historian Adam Tooze called polycrisis, overlapping financial, geopolitical, ecological, and institutional breakdowns, none of which can be solved with interest rates or stimulus alone. This is the modern echo, not just economic, civilizational. Because when the financial mechanism fails, it drags down belief in every institution built on top of it: governments, media, schools, law, elections. It starts with a bond crisis and ends in a legitimacy crisis. That's why understanding 1937 isn't nostalgia. It's a warning. It wasn't the crash that broke the system. It was the recovery that never stood on solid ground. And now, here we are again, holding up numbers that don't reflect lived reality, hoping the next intervention will stick, pretending that this time we'll thread the needle. But the truth is, the thread has snapped, and the hands holding it are the same ones that frayed it in the first place. We always think it'll be different this time, that we've learned the lessons, that the tools are smarter, that the people in charge know what they're doing. But systems don't fail because of bad intentions. They fail when the numbers grow faster than the trust that holds them together. In 1937, the illusion collapsed not because people stopped trying, but because math stopped cooperating. The numbers didn't care about speeches, optimism, or promises. They cared about velocity, credit, and solvency. And when the math turned, everything followed. It's the same now. If you're hearing this in 2025, you're living through a pattern, not a surprise. It's not the first time inflation followed stimulus, not the first time debt crowded out growth, not the first time central banks tried to do too much, then pulled back too fast. You're not in a new crisis. You're inside a rerun with modern graphics. The difference is speed. The collapse of confidence that took months in 1937 now takes days. A bad CPI print, a hawkish Fed meeting, a geopolitical shock, and entire sectors freeze. Liquidity vanishes in a weekend. Markets reprice in hours. Banks fail overnight. We live in the most connected, leveraged, and psychologically fragile financial system ever built. And yet, it rests on the same old delusion that you can print prosperity, borrow safety, and schedule recovery. But the system doesn't run on press conferences. It runs on reality, on energy, labor, trust, and time. And when those get distorted for long enough, the correction isn't a choice, it's a law. Arithmetic cannot be deceived. So what do you do now? See clearly. Stop chasing headlines. Understand that what's happening isn't chaos, it's consequence. And if you know that, you're already ahead, because most people will keep waiting for things to return to normal. But normal never comes back after a pattern completes. Only a new system emerges, or collapse finishes the work. And history shows us, if you don't build the next system on truth, the next illusion will fall even harder. If you've made it to this point, comment, "I see the pattern,"